Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, November 10th, 5:35 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are still in a correction, bear market rally, but with a short-term uptrend and a changing character today. Very bullish day in the market, sparked by a weaker than expected inflation report when the CPI data came out this morning. You can see over here on the trend gauge, if we'd have just taken cues from market leaders, they continued to hold up pretty well. And I mentioned yesterday on the ugly move down leading into CPI, the market always will do its best to separate you from your capital. I mentioned a bunch of leaders pulled back and held their 21-day exponential moving average, so really outperformed what the indexes did yesterday. And then the 8:30 this morning, the CPI data came out. The futures went from up about 1/3% to immediately up 3%. Massive gap. Opened up about 3.8% and really didn't give back much during the day. Definitely some short covering going on as part of that, but definitely also leadership participation and also junk participation. But the leading sectors outperformed value sectors very clearly across the day, so that's a good sign for growth stocks. You can see we upgraded the arrow on short term. If we can get another close on the NASDAQ 100 above the 21 tomorrow, we'll go full bullish on short term versus the 21-day exponential moving average. 50-day moving average, we get a close there too on the NASDAQ 100. We'll be able to go to bullish also. And long term, we added the small caps and mid caps above the 200-day moving average. Dow and NASDAQ 100, S&P and NASDAQ 100 still lagging below their long-term 200-day moving average. You can see the results on the day, very green. G6 up 7.23%, led by, I mentioned a junk rally, led by ARK-K up 14.5%. S&P 500 ended up 5.5%. NASDAQ 100 up 7.4, Dow up 3.7, mid-caps up 5.8, Russell 2000 up 6.1, Global Diversified 60/40 stock and bond up 3.9. GROTECTION, we got stopped on some things yesterday. That wasn't good timing. And then when you get a 3% gap in the blink of an eye, that's also not good timing. But what we were invested in, with the exception of one ticker, did well today. And we added a couple of things. We'll discuss that when we go into the trade review and the tail of the tape, but it's really not about one-day returns. If you look at this, you'll think, boy, that portfolio sucks. But if you look at it every day, you will recall back during the massive 3 legs down how we would be flat while the indices would be down 3-4%. And those days piled up, gave us a big lead year to date, and now we re-engage with the change in character in the market and look for low risk entry points. And there really were not, believe me, I looked at so many charts today, there were not a whole lot of low risk entry points, because when you go from being on the 21-day exponential moving average to gapping up 5% at the open, that's not low risk anymore. That was a situation on the indexes and also on a bunch of individual stocks, but we did add a couple things to the portfolio, and we added to an existing holding in addition to getting oddly stopped out on one. We'll talk about that when we get to the trades, but let's move along. We'll do the tail of the tape and then charts of interest. So let's talk about our approach here at Revere. And it's all based on a high-level look at what's going on in the overall indexes and how that trickles down to leading stocks. So we're fully transparent, as you know from doing these videos. Fee-based only, no conflicts of interest. We're a fiduciary registered with the SEC, a registered investment advisor. Our flagship portfolio is named GROTECTION. It's designed to grow assets in an uptrend and protect them in a downtrend. We've been protecting them all year, and now with the signals that we're getting, it's time to grow them with reasonable entries in the indexes, in sectors, and in leading stocks. So we manage individual client accounts using these trend following rules based on the 3 time frames and on leading stocks that I referenced in the trend gauge on the prior page. In an ideal uptrending market such as we had over a year ago, last October, November, here's the market trending above the short term, medium term, and long term moving averages. Will be fully invested in the market in a market like this. If things start trending sideways, our stops will take us out. We'll reduce exposure a little bit. If we go into a downtrend, that's when the slopes of the lines of the moving averages start to roll over. We'll lighten up even more, and if we break below this black line, the 200-day moving average, that is when we get to a maximum defensive posture, and that's because of this chart here. Last 13 bear markets, what it takes to get back to even. This is not something you can handle if you're approaching retirement. If you look at our podcast, which actually got released early, we did it a day early this week. Dan talks about a great sequence of returns article and how, as you're approaching retirement, you just don't have time to recover and plan correctly and live the life that you had planned for if you suffer massive drawdowns going into retirement. So not quite a severe bear market this year. We're over 10% off the lows, but we were down 27.5%. The index is the S&P, I think, is now down about 17%. To rebound from that, you got to get a 38% gain back to even. Severe bear market from 44%, you got to get 80% back to even. That's why our number one job here is downside protection, and the gains will take care of themselves when the market gets back into a more friendly posture for indexing or for investing. So, and then of course we have various rules for getting back in, such as an undercut of a low and a reclaim, which happened back on 10/13, follow through days like on 10/21. And reclaims of moving averages, which is what happened this morning. And if you're interested in an approach like this, give us a shout. Email don@revereasset.com. You can also email dan@revereasset.com. That's Danny Stewart, my partner. The phone is 855-REAL-WEALTH. That's 855-732-5932. So you can see the big gap up here at the open. Let's go to a 5-minute chart here. And sideways for a little bit of a pullback. But really just a series of higher highs and higher lows today. All the pullbacks were bought, very strong afternoon rally. And when we tested and held various levels, we added to our positions. Let's go to the NASDAQ 100. It was around 1 o'clock today when we were Eastern time, when we were doing the podcast, and I commented where the NASDAQ 100 was sitting right now, right into the declining 50-day moving average. Any weakness by the book would be a short. That was happening right here. And that's it. We tested it, we pulled back, and then we started making higher highs. So here we're right into the 50-day moving average. We paused for about an hour, and that was it. And then the market reclaimed it, went sideways again, strong into the close. Does this mean we're 100% out of the water, out of the woods? Absolutely not. There is no 100% in the market, and I'm going to go back and revisit. Was checking my notes from big moves off of the COVID low, and we're going to take a look at those before the video ends today. So there's your NASDAQ 100. This is the weakest of the indexes. One close above the 21, one close above the 50-day moving average with this big 7.4% day up. Let's go to the Dow Jones Industrial Average, which is the leader and made higher highs today. Closed right on the 200-day moving average yesterday, big gap up. Up the least of the indexes at 3.7%, but that's typical. It's a defensive index, and you can see the relative strength line dropping, and that's typical also. When you lead this thing, you don't lead forever. None of the indexes lead forever. When you look at the NASDAQ 100 and the Dow, when they get too stretched opposite one another, when you're comparing them, there's a snapback there too, very similar to what you saw today with the Dow, or with the NASDAQ being up about twice what the Dow was. Let's go to mid caps. These have been acting relatively well today, and you can see the gap up and close above the 200-day moving average. So another good sign there. And then small caps close right below the 200-day moving average. I thought they had gotten above, but actually on their versus there, if you look at a weekly versus their 40-week, just below it by by 17 cents. So we're right there. That's considered resistance, but we will pay attention on both the daily and the weekly charts. We want to see that get above. We want to see this hold. Now, let's go to the Dow, the S&P, and let's go back 2 years to COVID, when you can see some of these violent moves off the bottom. So here was really 3 tight legs down in COVID: down 1, down 2, down 3, a close. This is really an island bottom. And then the next day, and this was, I was looking at my notes on 3/24, Trump said we think we can reopen everything sooner. We had a big gap up. The S&P 500 was up 9.4% on the day. So then the question you ask yourself is, what starts happening after that? And we're going to look at the S&P and go through this day by day. So follow through strength the next day and the day after that. Then we started coming into the declining 21-day moving average, where we paused, pulled back. And I remember this day specifically, I thought we were going lower, absolutely, 4-3 for certain. And then the next day, we gapped up. The news was the COVID stats were weakening, was the headline, and we gapped up and we're up 7% on the day. And the rest of it, that really kicked off the big rally with just a couple of consolidations going into the end of the year. You can see how choppy the gaps were, though. So the best way to play it was to keep your position small, stick with a moving average that when it was obeying, you could add to it. When it pulled back into it, if you got extended, you could take some profits. But it took about a month after that before, this is really the meat of the move here, where things really tightened up after the most recent correction and you stopped gapping. Let's go to the NASDAQ 100. Very similar situation. Here was the bottom, the gap up, 7.7% on the day, ran into the 21, 3 days of a pullback, and then the follow-through day on 4/6, up over 7% again. And then it kicked off, and really a much smoother, big growth stocks were leading this rebound here. You can see the 21-day moving average held the entire move up with just one close below, and then we just got way too extended. I remember this day also putting the stop sign on the daily report on September 2nd, when we got 7% above the 21 and 13% above the 50-day moving average, and then we formed a nice little cup and handle that we then broke out of going into the end of the year. And really, if you compare, there's similar action to all of the 13 bear markets that we've been studying as part of this whole sell-off. Now, this one's longer, so it's more similar to the 2000 and the 2007 bear market. A lot of fits and starts, a lot of false moves. Hopefully this changing character day will be similar to the changing character day on 4/6. After COVID, that kicked off a big run. The similarities were, in this case, we're hoping that the Fed stops the rapid pace of rates. There was mixed info coming out from speakers today. Evans was dovish. Mester, as she always is, was hawkish, and that was responsible for the intraday pullback here. This is right after she talked. We pulled back from 39.27 to 38.97, and then when we bottomed at this key area, this 3900, this is when we started adding some more positions on. So we survived her tough talk, and the market closed at its high. Do also want to go back and notice that some of the pitfalls that we have to worry about here after this big follow-through day. The next day on 4/7, we gapped up 3.6%, and that was at the high of the day. Had a massive reversal from up being, and this is what happens if you chase. And this could happen today. It didn't, but you always have to be on guard for it. The pullbacks were contained today. After a 7% up move and then another 3.6% gap up at the open, we just trickled lower all day on 4/7, closed at the lows. No doubt some people that chased at the top got shaken out of some things, but we recovered it the next day, made a higher high, and then just started making a series of higher highs and higher lows, and for the most part obeying the 21-day exponential moving average. So this is the type of thing that we're comparing the current action to. Across the other bear markets, there's a lot of consistencies with them. Some are easier, some are more difficult. This most recent 2 weeks has been extremely difficult with the mixed messages from the Fed, and then the big negative reversal on Powell. But the next day down, the gap down held, didn't go any lower than the key support at 3,700. We rallied a little bit, had to shake the last bulls out yesterday with a shake back below the 21 and the 50-day moving average. We gave up some of our positions yesterday as our stops were hit, but re-engaged today with the move up, and we'll see where this takes us. Let's go to the subsequent indexes that we want to look at. Gold. With the weakness in the dollar, gold with another gap up and closing at the high of the range. So weakness in the dollar. Let's look at this. Big gap down when the data came out, closed down 2.2%, broke below the range of the base that it was recently putting in. So now it's below the 50 and the 21. The 21's rolling over. This is just the equivalent of a failed base if you wanted to compare it to what a stock's doing. So now we'll see. Marcus Smith just redraws the lows of the base, but before today, the low of the base was right here, and now we broke back below it. So this move up on the dollar, that was broken support. We'll see if it's resistance around this 29.50 area on the dollar and see what happens when it's there. Very clearly, the dollar is still in an inverse relationship with what's going on in the market, and it's not something that we can ignore. How about the VIX? The VIX was had been, you've been thinking, when we mentioned it multiple times during this move down in the VIX, it was consistently moving lower while the indexes were chopping. We got very oversold. We spiked yesterday in the last 2 days, but never got back above that 26 level, and we've been in this 24 to 26 neutral area. We broke below it today, and with another spike, with a spike lower on the stochastic. So now we want to watch and make sure we stay below this 24 area on the VIX. That will give an additional tailwind to the bulls. So VIX below 24 is definitely something that we'll be keeping an eye on. I talked about gold, Bitcoin. This whole fiasco with the FTX exchange is trying to get worked out. Let's go to a 60-minute chart here, and you can see that we had a rebound of 12% today on Bitcoin. We're not going anywhere near this. There's just no reason to, but a lot of people ask about it, so we'll discuss it. I talked about the dollar, the VIX. How about the bonds? Big price move up today. That means big yield move down. Here's the 10-year. Broke below the 21-day moving average. That's a change in character. It's also what you want to see to give credence to the move in stocks. Big move lower in the yields right into the 50-day moving average, which we have been above since all the way back in mid-August when we broke out here. This last move down in rates coincided with a rally in the market. And then rates just started going higher as the market did its next leg down, but now we're gapping down on rates, gapping down on the dollar, and the market is participating to the upside. TYX is the 30-year, same situation, gap down, not quite as far, just below its 21, but again, one close below the 21, and you've got the stochastic pointing lower. So rates going down while the price goes up. We'll look at TLT. You can get the price here. As you can see, the big move up, and that closed above the 21 for the first time since all the way back, again, at the beginning of August. So next up, let's go to the tail of the tape, and then we'll wrap it up here looking at some individual charts. All the technical indicators are now pointing positive, from the stochastic to the NASI, RSI, to the dollar and bonds. Put call low, VIX below 24, fear and greed ticked up to 63, not surprising. So this 1021 follow through day, we could add on another follow through day here on 1110. So we're operating under the bull case. CPI data, jobless claims are also higher than expected. That's negative inflation, or that's negative economic data. That is good because it gives the Fed more reason to pause, as they don't want to have a hard landing as part of the supposedly incoming recession. Day count went from down 1 to up 1. I talked about the Fed comments. After CPI, my expectations were positive coming into today, as long as we held that 3,800 gap, which we absolutely did, with the positive gap and go above the support and resistance on the S&P, clearing this 3,900 level, above the support resistance level on the NASDAQ 100, this big fib at 286.82, which was a battleground a couple months back. That's the next area that we're watching. Sectors, 11 out of 11 up today: gold, silver, and gold and silver stocks. ITB, that's home builders, tech, real estate, retail, and small cap biotech outperformed today. On the downside was the dollar and managed futures, ETFs. Our focus was our holdings in some individual names, which we'll look at the charts momentarily. What we did today was add to First Solar, two additional buys, so it went from 2% to 4% to 6%. Bought SSO for index exposure, bought Steel Dynamics, Mobileye, and we sold STNG. Bottom line, weaker CPI inflation data sparks a major change in character rally. Next area up we're looking at is this declining 150-day moving average at 39.69, and then the 200-day moving average above there at 40.82. Notice we're already in this range. We're above it on the 30-week. We're below it on the 150-day, so we're actually inside this range today. Now let's go to charts of interest, and we'll start off with what we were owning today, specifically what we got stopped out of. All of the oil shipping stocks today were down. I didn't find any headlines. TNK is another one that is in the group. It was down today, but we're not giving back gains in this market. We locked them in, high single-digit gains. It did bounce at the 21, but I had mentioned I was using the 8 EMA in this 50 level, and when it broke below 50 in yesterday's low, I just didn't want to worry about it when there were too many other things to focus on that were going higher. So we wrapped up our profits in STNG, and this still looks fine. PI, we've been in this for a while. It did undercut its low. We sold a third of it yesterday, up 8.3% today, back into this range. Still trades on the thin side, but again, you know my fondness for earnings gaps. And then for solar, which we had a 2% size in, around in the high 140s. We added today around 155, and then at 156. TAN, Array acting well, Enphase acting well, the whole sector acting well, and a very easy low risk stop. It should hold above this 150 area on any pullback. So now we have 6% size on First Solar. Steel Dynamics, something that has been in the 21.21 and I've been watching for a while. After this very strong move up on volume, lower volume consolidation, undercut, came close to the 21 yesterday, higher volume today relative to the last 5 days. If you're familiar with the concept of pocket pivots, that's a 5-day pocket pivot. Back above the 8 EMA, good low risk entry. Came enough off of oversold with the stochastic hooking back up to give us a nice low risk entry point. So we bought 2% of that today. And Mobileye, this is something that years ago bought out by Intel. They spun it back off as an IPO. There aren't very many IPOs out there. This is an IPO U-turn pattern. If you look at it on a 60-minute, so the IPO price was 21. It got as high as 30, consolidated, now forming this cup and up 8% on above average relative to recent volume today. I had an alert at this 27 area and watched it, and it just continued to show strength all day. So we took a 1% size in this. It's a little bit more on the speculative side, but this is the type of if the market is really going to go to some growth stocks, this is a good low risk, low size entry to get involved in. And on the S&P 500, we added SSO to go with our SPXL position. So we do have the equivalent of 25% size long in the S&P 500. So our adjusted beta is 0.5. So basically half the risk and reward of the S&P 500, and looking for more low risk entry points throughout the rest of the week. Other stocks that we were looking at, I'll show the charts and discuss why. GFS was a gap up, an inside day. Didn't show much strength early in the day, so I kind of pushed it to the side, but some volume and price action did come in near 50, although it started out the day as a laggard, but really everything rallied late in the day today. GFS Wing, another one that we're watching closely, made a higher high with this gap up. Didn't like that there was no volume on it today. There was a lot of stocks moving without a lot of volume from my scans, and that I really wanted to see something where money was really flowing into it before I would commit to something. Did mention Array, another solar stock, day two higher high here, closed right around this 20 area. Good to see continued strength in solar stocks. BA just continues to be a badass, if you want to say that's what BA is for. Now wishing very obviously in hindsight that I had bought this on that second day above the 200-day moving average, but we will keep an eye on it. Money very clearly is flowing into Boeing. Axon, the old taser, with a day two higher high today. Sprouts, SFM, this was week early. Strength came in late, made a day two higher high. Halo, another one we were considering. Big move, big day two move up. But again, I'm not chasing anything extended in this. And then two fundamentally strong stocks that had earnings and acted well, but ended up going in different directions during the day. First of all, Celsius, look at this 5-minute chart on this. This gapped up about 14-15%, ran up into 100, and then just started selling off most of the day before a little bit of a rally into the close. And if you'll look at it, it tried to get above the 50-day moving average and failed and fell back into this space. This was people selling for whatever reason, selling Celsius today into the Livermore 100 area, and it just went lower all day. Contrast that with Bros, which really didn't gap up that much, sold off a little bit early, but then just chugging higher during the day. Big volume midday came into this, but going back and looking at post-trade reviews during the recent market rally, I bought some things that had broke out of bottoming bases that were still under the 200-day moving average and didn't really make any progress with them. So I'm just not going to get invested in anything that is below the 200-day moving average, which I may miss a stock here or there, but I'm pretty sure from the concept of overhead resistance that the odds are not as much in my favor as they are with things that are closer to all-time highs. So that's the end of the charts, and that's going to wrap it for the day. As always, love to hear from you. Don at revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. So 50% engaged, 50% of the risk of the market on this changing character day, and we look to continue to add if things continue to hold up. The good thing is that this is the first day up, although it was a strong day. You know how I go by the day count: day 1, day 2, day 3. Try not to be adding on day 3. You want to get your stuff in your portfolio in day one or early day two, or inside a consolidation day after one big day up. But day one count, we'll see how things unfold for the rest of the day. The worst thing that we could see tomorrow is a massive gap up and then a negative reversal, very similar to what I showed on that day after the follow-through day back after COVID. That would not surprise me if it happened, but it's not something I want to get sucked into. So that's going to wrap it. Remember, folks, it's not how much you make in the market, it's how much of that you can keep. Participate in the rallies, get out of the way, especially when you're under the 200-day moving average, or when the slopes of the lines of the 50-day or the 21-day are moving lower. Work your way back into positions. Growth stocks outperform the market by a factor of 2 to 3 or more if they're the strongest. That's where we want to focus our capital when the wind is at our back. So wrapping up, Thursday, November 10th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.